Yo, what's up guys? Realty Income just reported the most amazing earnings and I'm about to show you why. And I like that Realty Income's doing good because the stock market is not doing good at all. If we go over to the past week, my portfolio is down nearly 5%, but Realty Income isn't really reacting much after hours, which is kind of what I expected. These triple net lease REITs don't really move much, but anyway, I want to show you the most impressive part first. So we're going to get straight into it. I hope you guys enjoy this kind of stuff. Don't forget to drop a like on the video. But first off, this is this quarter's, as of July 2024. So this is their most recent investor report that came out literally minutes ago. And this is their current annualized dividend of $3.15. If we go ahead and look at last quarter's, it was literally $3.08. So they're growing their dividends since last quarter, which is really impressive. Their total rentable square feet didn't change much, just a million, but this is the most impressive part. I'm going to go and get straight into it. And I think a lot of people are going to overlook this. So check this out. I like that groceries are the top industry for them. We have stocks like TJ Maxx, Kroger, Walmart, Costco. All these grocery stocks are at all-time highs. So I like the grocery industry. But check this out. The industry I didn't really like about Realty Income was the dollar stores and Walgreens. And here's what they just did. Since last year, look at this. Their exposure from dollar stores went from 7.1% to 6.6%. And their exposure to drugstores, which is Walgreens, went from 5.5% to 4.9%. So this is huge. I tried to spell out huge, but this is crazy. This is the honestly best part about the investor presentation, that they're getting away from the dollar stores. And also we can kind of see their geographical diversification. Did you know that 11% of their revenue actually comes from the UK? But now let's go and get into their AFFO stats and see how sustainable is their dividend. And let me tell you, their dividend payout ratio is very safe. So this is this quarter, and we have their AFFO per share of $1.06. And remember, their dividend cost 80 cents, just under 80 cents per quarter. And REITs, if you're like, that's a high payout ratio, REITs have to pay out most of their dividends by law. So if we actually look at this, they calculated a payout ratio. Yeah, so only a 73.3% of the diluted AFFO per share. So I like that. They did the diluted AFFO. And on top of that, they just reaffirmed their guidance. So this was also super impressive. If we look at the prior 2024 guidance versus the revised guidance, you're going to be like, what changed here? Because their AFFO didn't change, but this is also important that it didn't change. That means they're reaffirming this super bold. This is honestly an aggressive AFFO estimate, and I like that. So the only thing that changed here was the net income per share, and you don't look at net income for REITs because it doesn't add the depreciation and the amortization, which is super important for real estate assets specifically and for REITs. And that's why you look at the AFFO per share. The occupancy rate is over 98%. Another thing great about that, but I want to quickly do a multiple based off this AFFO per share right here. Remember, we'll do a conservative one based off $4.15. So we do $4.15, and what's a fair multiple on this? Like, what's a 15 times multiple? That's a $62 stock price, and today Realty Income is trading at 59. I could honestly see Realty Income cranking up to like a 17 times. I could see Realty Income going to $70. Hashtag not personalized advice, not financial advice. We're wearing our McDonald's shirt. You probably don't want to trust me. I got my McDonald's shirt on because I'm probably going to have to go work back at McDonald's with this market crash. But anyway, let me show you another thing from their investor presentation. This is last quarter's. There isn't this quarter's yet, which we'll get at later. But look at this. They have consistent occupancy levels during various economic cycles. Like, look at this. The blue chart is the median S&P 500 REIT. So the REITs in the S&P 500, so those are already quality REITs, but Realty Income is way above that at 98.2%. And that was actually as of last quarter. They actually have a higher occupancy rate, which I'll go ahead and show you. And this is actually super, super impressive as well. I'll show you this. So look at this. They have a total of 15,450 properties. 15,450 properties. Only 185 of those properties are for lease, for sale, or vacant, which literally makes the occupancy rate at 98.8%, which is so impressive. Like only 1.2% of your portfolio to not be occupied. That's crazy. And of course, this company is A-rated from Moody's and S&P Global. They're inside the S&P 500, and they are a dividend aristocrat, which means they have been raising their dividends for over 25 years. They never had to cut their dividend, through some really tough times like 2020, 2008. They've never had to cut it. Also, I don't think I pointed this out, but they have a lower leverage ratio than they did from last quarter. Check this out. The leverage ratio this quarter is 5.3x. If we head over to last quarter, it was a 5.5x. So that's actually quite a bit lower leverage, which is good to see. It's the little things that add up. But yeah, guys, hopefully you appreciate my breakdown. I try to keep it short and simple. If you did like it, don't forget to drop a like on the video. And if you want, you can become a YouTube member. Hit the join button. No pressure. But if you leave a comment, I'll respond to every single one of them, and I'll catch you guys in the next one.